Thank you, everybody. I am going to pretty much get us out of here on time, but I have an important message I want to share with you today. My disclaimer is this. We're all adults. If you go and use something I told you and lose a bunch of money, it's on you, not me. That's my disclaimer. I want to talk to you today about, I have alphatrends.net, which is a swing trading service. And I want to talk to you about a swing trading setup that really is becoming my favorite. I've been doing this a long time, and it comes down to supply and demand. So what is a setup? A setup is having a plan. It's saying, if then, here's how I act. If the stock goes above this certain price, I'm going to buy it. But if it reverses back down, I'm going to sell it and take a small loss and move on. And I'm going to have a strategy also for managing my risk along the way. So what is swing trading? Swing trading, some people say it's 3 months, 2 to 3 months is a swing trade. For me, I view it more as it could be a day trade if I'm absolutely wrong on my entry, but generally up to about a month or so. Beyond that, it's the trends just kind of peter out. They need to digest a little bit. So what we're trying to do is leverage time, really. We want to be in the stocks that are moving now and avoid the ones that are doing nothing. It's not for every dollar of your account. Sometimes it horrifies me that people will come to alphatrends.net and they'll say, hey, Brian, I've just cashed out a company and I heard you're good, so I want to be a swing trader. And I said, okay, cool. How much of your money are you going to do this with? And they say, what do you mean? What percentage of your overall plan is this for? And they say, well, I thought I was just going to do it all. Well, no. It's for a small part it's the active part of your plan. So how long do you hold? It's always subjective. What works for you? The science of technical analysis is what we can do and look at on charts. And I'm going to give you some actionable ideas for Monday. I've got a long setup and a short setup that we're going to review, and we're going to take a look, and we'll see if they work or not. The last idea at Trade Ideas, I gave it a talk about, it was a short, and the thing fell about 50% in the next 2 weeks. Now, I'm not guaranteeing any past performance is indicative of future performance, but we want to look at, what was that? Hopefully, yeah, and then this entire one. So we have to begin with some structure. We have to say, what is the trend of the market? So Jake was talking about multiple time frame analysis. That's my book, Technical Analysis Using Multiple Time Frames. So I love they're doing that stuff. But just to keep this real simple, the 4 stages. This is Wyckoff, this is Weinstein. This is not something I invented. I created a cool infographic about it that hopefully you guys are learning from. This is a very simplified version of it. We have stocks that are either going sideways, stage 1, or sideways, stage 3, indecision. What do we do with those stocks as swing traders? We ignore them. If they're not in a trend, what's the point? I'm not trying to write butterflies and condors and do all these hedging and that. We're talking about directional returns, getting in for maximum return possible with the least amount of risk that we can. So how does someone get to India, from India to this Quicksilver chair? Did you look at a map and say, Quicksilver chair, that's it? No, you said, I got to get to the U.S. And when I get to the U.S., I've got to look at my map. Now, I look at the globe first. I look at my map and I say, there's Colorado. I got to get there. Now I've got to take an Uber. And if you're Donnie, your driver quits halfway through, and you have to come up with a backup plan. But you drill down from the bigger picture. So we can't begin a swing trade by looking at, what's the stock done in the last 10 days. We have to look at it and say, in relation to the bigger picture, we're looking for trend alignment. So it's the same thing with the mountain structure. If you skied today, who skied? Everybody, I think most of the hands went up. I think someone answered that question earlier. But when you were on peak 8 looking to get to peak 10, or you're trying to find your friend on the mountain, you don't just say, oh, well, it looks like, it's real white. There's a bunch of trees here. No, we have to add structure. We have to say we have names. We have trails. we have a way of defining the information up on that top picture and saying, how do we look at and define structure and trends? One of the most basic technical tools is a moving average. A moving average is a very simple reference point that we can compare price to. It's a constant to compare price to. It allows us to look at it and say very objectively, is the market trending higher or lower? We can use all kinds of time frames. We can use a 5-day moving average, a 20, a 200, and it depends on what your time frame is. And not enough people talk about that. We see all kinds of opinions on television, on Twitter, and someone will just say, excuse me, one of my pet peeves is, Brian, what do you think of eBay? Well, tell me a little bit about your thought process first. I don't know how to answer that question because you've given me no information. Are you in it and you've been in it for the last 10 years and you're looking for a stop, you're close to retirement, you're looking to write calls, are you looking to buy this today? Are you looking to short it? Give me some feedback. What's your time frame? Each and every one of us should look at the market differently. No two of us are alike. So we have to look at it and say, let's just look at the basic structure first. Is it in an uptrend? Is it in a downtrend? What is, looking at just one moving average, I like to call it the dominant moving average for whatever that time frame is. It allows us to quickly say, what's the trend? Where are we? What does this picture have to do with this? Absolutely nothing. It was a cool picture I took from the drone of us. No, this was Cooper Mountain when we went cat skiing the other day. Yeah, so these are pictures. So we're doing a little reminiscing of the weekend in here as well. But we want to trade in the direction of the primary trend. So when we look at the dominant moving average for the time frame we're looking at, we're going to talk about today simple moving averages, because I'm a simple guy. And let me just ask this. In this room, do you use simple moving averages? Okay, so look around, everybody. Or do you use exponential moving averages? So, but how about both? Okay, my opinion is most people, if you looked around, most people use simple moving averages. That's why I'm interested in them. We're looking at it not as a timing tool, and not that I'm going to buy a pullback to the 50-day moving average. I'm going to look at the 50-day moving average and say most people look at a simple, but the 50 simple or exponential, they're going to be within cents of each other. So if you're using it as a timing tool, then that's a different story. I don't think they're a timing tool. They're a trend identification. So it doesn't matter. There's no difference. So the big difference, though, is the volume-weighted average price. And most of my talks the last year and a half have been about the volume-weighted average price. So I wanted to go back to swing trading and incorporating trended multiple time frame analysis, simple moving averages, and the volume-weighted average price. Who here is not familiar with the volume-weighted average price? Awesome. VWAP. Let me ask you this, Tyler. Don't get me started. Say these words real quick. Apple. Opportunity. Okay. VWAP. Average. No, it's... All right. Stop. I've got important things to say here. And we still have a lot of booze to drink. It's paid for, and it's going to my basement otherwise, because I live closest, and JKC can't bring it on the plane. So on a daily time frame to represent, what is the bigger picture for a swing trader, just a simple 50-day moving average. What's the direction of that moving average? And, when it's below a declining 50-day moving average, it means the trend is lower highs and lower lows. Can you make money buying stocks in downtrends? Sure, but you got to be super nimble and look at the definition of trend. Lower highs and lower lows. That means it drops 20 points and it rallies 15. It drops 30 points and rallies 20. Mathematically, there is just more opportunity in the direction of that trend. So why try to fight it? Why try to be cute and catch these little bounces? Wait for it to flatten out and then start to move higher. On an intermediate term time frame, so we're looking at multiple time frames, we're going to identify our trade candidate on a daily time frame, and then we'll go down to an intermediate term time frame. So here, I didn't reference what the time of each of these candles is. There is a clue up here, however. Who can tell me what time frame this is and why, based on the information on here? It's a 30-minute, correct, and why? Because the moving average is 65. Thank you. So there's 65 30-minute periods over the course of 5 days. That, to me, is we want to identify the picture, bigger picture, and then we want to say, what's the definition of trend? Well, here we see lower highs and lower lows below the declining moving average. It starts to flatten out. Then we make a higher high above a flat to rising 5-day moving average. And then we see higher highs and higher lows, distribution, and then decline, the 4 stages. We see them all here. Decline, accumulation, markup, distribution, and decline. It's pretty basic stuff. If you've been looking at my Twitter for the last month and a half, I've been updating this chart. I probably need to switch to a 65-minute time frame, but this is the December 24th low. We were below a declining 5-day moving average. So just like the cover of my book, that means it's a bearish period. Then we get above the 5-day moving average, but it's still turning sideways. So we're cautious. We're thinking maybe it can turn. We don't have price confirmation yet. We're in this neutral zone. Let's get ready. And then it looked like it was breaking down, but it didn't go negative because the 5-day moving average is still advancing. This is where it went positive. It made a higher high above the flat to rising 5-day moving average and continued to do so all throughout here. It broke below the 5-day moving average, and the 5-day moving average flattened out here, so that was a cautious zone. If it broke below here, I was looking to get short. My bias at this point was I was thinking it was going to break down. But instead, it continued back higher. Who am I to argue with the trend? The market doesn't care about my opinion. We had another cautious zone, and then the buyers stepped back in again, and now we're up to, the 9th week in a row. We're at recovery highs, and we're closing on new all-time highs. So the volume-weighted average price, we're going to combine together with that. We heard a lot of talk about sentiment. To me, it's the perfect sentiment indicator. It's about sentiment. It's who is objectively in control, the buyers or sellers. From this morning, from the beginning of the year, since any period you can come up with. It is the basics of price, volume, and time. And you combine those 3 together, that's what the VWAP is. Only price pays, that's how we keep score. Volume, it shows us the emotional commitment level, but do we really know what's happening? Unless we combine it with time and mix these all together, it's not a crazy formula. It's not a mathematical, some scientist came up with. And I like to anchor it. That's why I knew Tyler's question about Kahneman, because one of those heuristics is the anchoring bias. And what it basically means is, for instance, since the beginning of the year, right? Are you up or are you down? That is a benchmark that all portfolio managers are measured against. The good ones, the hedge funds. The other ones are versus your index or whatever, your industry. But the point is, how about, I put this on Twitter earlier in the week, but this is from an event. What is the average price paid? It's basically a dollar cost average for the stock. What is the average price paid for Apple? Well, here this is late January. The stock reported earnings. It gapped up. Buyers maintained control. They are still in control. It got a little bit ahead of itself maybe, but money was still flowing in. The average price was increasing. Now the average price since the earnings is about 170. The stock is 173, so the average participant is making money. Now look at this. So a lot of people look at it from just a daily time frame, but here we have a month of data, and look at how it was almost perfect touch in there as support. You could look at all kinds of moving averages and try and backtest, and you can try to automate all this stuff, but there's an art to technical analysis, and there's certainly an art to trading. What do you do with this information? How do you turn it into something? I think that there are awesome tools like TrendSpider, like Trade Ideas, who can give you shortcuts, but you have to understand what's happening here. What is happening? Well, I don't know this for a fact, but I think there are portfolio managers out there that said those earnings were great. The stock's been beat to hell. It hit the 200-week moving average. It hit a 61.8% retracement of the prior move. And now they're showing good earnings. So let's buy 20 million shares over the next 8 weeks. I want you to piece it out, and I want you to beat the VWAP for me if you can over that period of time. So when it gets down to that level, the executing broker scrambles to buy as many shares as he can because he's probably left behind. He had to chase a little bit up there, but they act as a hidden level of support. It's true supply and demand. There is nothing more objective than the VWAP. I will arm wrestle anyone for that. I don't care how big. I'll do it with John back there. Anyways, so for swing trading, what we want to do is Dow Theory. What is Dow Theory about? Different time frames, right? The oceans, the currents, the ripples. Well, for a swing trader, in my time frame, the way I look at it is I want to identify my opportunity on the daily time frame. That's where we use that 50-day moving average. Is the 50-day moving average advancing or declining? How far are we too far above it? And it just doesn't make sense. Well, we look at the intermediate term time frame. For me, an intermediate term time frame is either a 130 minute, a 65, or 30 minute. Why those weird numbers? Why not an hourly chart? I know some of you know this, but I want to hear someone tell me. Why would we use 65 instead of 60? Why would we use 130? Steve? 6.5 hours in the market. There's 390 minutes in the day. So if we're going to have 6.5 hours in the market, I want to look at 6 equal candles of 65 minutes. Because especially if I have a MACD or some moving average, that first half hour has the same weighting as 6 1 hours. There's nothing more important about that. So we have to look at equal increments of time. If you're not doing that, all of your analysis is flawed if you're using especially oscillators and indicators. Now that we've identified the trend and we're coming up with our plan, our setup, we say, on that intermediate term, what am I looking for? I'm looking for potential zones of supply and demand, support and resistance. I have pet peeves about support and resistance. I think I touched on that yesterday. People say it's at resistance, it's at resistance. No, you don't know that. It's at potential resistance. And we keep blowing through all these levels. But if we look at the intermediate term time frame like we did on the S&P, we can see where to get cautious and where to turn back to bullish and say, no, the market is telling me there are still aggressive buyers. So then we look to a shorter term time frame. It could be a 15-minute time frame, a 10-minute time frame, a 2-minute time frame, but we're fine-tuning our entry so we can say, I can get in hopefully at the moment of the inception where the trend reemerges and set my stop in a place where I don't have a big problem. So how many of you guys did some double diamonds? It's risky, right? Again, know your risk. You could die financially if you're shorting stocks in an uptrend or if you're buying stocks in a downtrend. What is the point? So 2 questions always to ask, and the goal is to determine your risk reward. Where does the stock come from? I have people that constantly ask me, hey, Brian, what do you think about this stock? And I'll look at it and I'll go, it's been up 4 days in a row and it's up 12%. Where has it come from? Why do you want to buy it now? You're chasing. You've got FOMO, fear of missing out on this opportunity. Wait for it to settle back down. What is a normal type of move? Is it reasonable to think a stock that's up 12% in 4 days is going to continue to go? It does happen. And if you want to chase those stocks, just have a really tight stop. I mean, you can make money off them, but the point is it's about probabilities. Where is my best opportunity? So, and what is my potential reward? I don't really like price targets. I let the market try to decide that, although I do scale out of a trade, and I'll tell a little bit more about that, but it's about perceived risk reward. And if you're a really crappy technical analyst, you're going to get crappy results. And if you can't control your emotions, you're going to get bad results because it's garbage in, garbage out. You can convince yourself of almost anything. You can draw a trend line in any direction, connect to whatever points you want, and convince yourself that that's the right way to do it. And this kind of goes back to what I was saying yesterday. There are some hacks on social media that have followings and they can't even draw a trend line or basic little things. The things that people call a flag. I mean, there's one real violator of this that I will not mention their name, but if you probably know. Anyways, what's the perceived risk to reward? These are actual stocks that I've posted just recently. This one is actually Procter & Gamble. And I put a tweet out on it, and I said, this is a stock I wouldn't trade because it's a big, boring name. It doesn't suit my personality, but I'm sharing it with you because maybe it suits your personality because the setup is strong. It's above, this is a year-to-date VWAP. This is the 50-day moving average. And if we saw volume, we would have seen that it spiked there and pulled back. And, prior resistance here acting as support, that's a good candidate. So then we look at that candidate on a shorter term time frame. Here's the 5-day moving average, starting to settle in there. This is the volume weighted average price from that peak right here. So we can see money flowing out of it, but it's beginning to stabilize. The 5-day moving average is advancing. So when we look at the 15-minute time frame, we can see this is the same exact point right here as that. As it got back above that volume-weighted average price off the peak, and the 5-day moving average was flattened out, it made that higher high, I looked at it, and I told my subscribers it looks good, but I'm not interested. I'm smarter than that. And the stock went from 95 to 98.50 uninterrupted. And as it got to that 98.50, what do you want to do up in here? At this point, you've got another group of people saying, hey, it's breaking out. And they're waiting for this breakout. But if you use multiple time frames and drill down, you get in here, you sell a little piece to them because it typically pulls back. And you manage your risk. You set your stop under the most recent relevant higher lows. I'm not interested in 5% stops, 7% stops, 3% stops. I don't know what the stop is. I want to control my risk by saying, I'll risk $500, therefore I see the stop either underneath this higher low or this low. Is $1.25? If my risk is $500, I'll do 400 shares. That's it. It's not percent. It's about percent at risk. So that trade worked. This is one that's still open, actually. We got very lucky on it. You never know what one's going to go. This is SMAR, Smartech. Same thing. Above the 50-day moving average, higher highs, higher lows. Nice tight little compression in here right at the 5-day moving average. It makes the higher high above the 5-day moving average. And that's this point right here after the entry. And look what happened. It's just continuing to make higher highs and higher lows above this 5-day moving average. From 20, I think it was 28, here we are now 10 points higher in 3 weeks. This is most likely going to get stopped out on Monday on the final third that we have open. So this is how we're looking at it. These are the two opportunities that I see for Monday. Crocs. I don't know what the fundamentals are. They still make ugly shoes. They always have made ugly shoes. But we have a rising 50-day moving average. We saw it pull back and find support at the 50. That was the swing low. The next swing high was up here, and it began pulling back. Kind of, it went above and below that 50-day moving average. That's why you could point to it and say, see, if you bought at the 50-day moving average. Okay, well, what about that one? Now, I'm still holding it, but you don't need that initial, pullback, drawdown. So here's how I'm looking at this now. This chart's through yesterday. So this is a current setup. This is a 65-minute time frame. So we're taking a volume-weighted average price off of that swing low right here. That's this point. And we're saying the average price from that low, now the average participant has been losing money. if you count in all of the dollar cost average. How about from the peak? That's that red VWAP. And you can see how it found resistance here the other day. I'm getting dizzy doing that. And the 5-day moving average is advancing. So we have, what do these two VWAPs mean? They're converging together, and they're saying that the sellers have had control for the last couple weeks. But now it's flattening out. We're banging up against it. What does that mean when we're banging up against resistance? It means we're working through supply. Supply is starting to overwhelm demand. It's not there yet. So now when we look at the 15-minute time frame, we're in anticipation mode. Okay, so we identify our opportunity. We look at it and say, what's our potential risk reward? So thinking that if it can at least return to the old highs of 31, and then the breakout crowd, buys it, right? We're up $3 at that, or $2.50, right? So we're going to get involved if it can get above these highs. And where do we set our stop? 3% away, 5%? No. What's the definition of trend? If we buy it with a higher high on the short-term time frame, we want to say, what's the most recent relevant higher low? Set my stop under there. And if it starts to move higher, we'll take a little bit off. We'll raise our stop up. So keep your eyes on Crocs on Monday, CROX. On the short side, we've got a company called, I don't know what they're called. The symbol is EDIT, though. Did I not put it on here? Oh, it is. Okay, so EDIT. I have no idea what they are. I don't really care. I'm not an investor. I'm not looking to read their 10Qs. I'm looking at this and saying, this stock is a problem. It's a mess. As JC would say, this is a hot mess. That was his accent, too. I'm not sure I did it right. And his enthusiasm. Well, a little less. But this is the December low in here. And it bounced up, and again, right to the declining 50-day moving average. So there's, institutions use this stuff. That's why it's on every IBD Market Smith chart. This is what big money is looking at. And when they see it bounce, they say, hey, let's lighten up. And then bad news comes out, whatever. And that's why you don't buy it with a declining 50-day moving average. So if we take this same kind of area and we say, from that low in December, the average price, they all turn to losers in here on that gap lower on the daily time frame. That's where the average participant from this low turned to a loser. How would you feel? Would you want to still hold this, or would you say, hey, there's still problems here, I got to get out? And people say, oh, it's all in short. So from this event, not particularly helpful in here. It's not about being helpful every moment. Recognizing that, hey, it's crossing back and forth above and below, there's no edge. Avoid. You don't have to trade the stock, but you can put it on your watch list and say, I'm waiting for confirmation. What does confirmation mean? It means if it takes out this low over here, and this is, again, a 65-minute chart, so we have the 5-day moving average declining again. If it breaks down underneath this level, I'm anticipating that if it takes out the low from late last week, from Thursday, this is Friday, if it takes out Friday's low, I think the momentum should continue lower and it'll probably break a lower low. So that's basically my first reasonable target in my risk reward. Maybe I can make about $1.70. Well, what's my risk? Again, the volume weighted average price from this most recent event where we had this big downdraft and the declining 5-day moving average and the VWAP off of the high on Wednesday when we had this little fake rally. So from this failed move, we have the potential for a fast move. Someone asked me to say that the other day because they heard me say that a lot. Yesterday, somebody said they wanted to hear me say it. So there it is again. But if it breaks, so we're in anticipation mode. If it breaks down here, I'm looking to short this. With my first target, $1.80 away, what's my risk? Well, here is the volume weighted average price from this peak, from this low, and there's our 5-day moving average. So that to me looks like the most recent relevant lower high. Again, lower highs and lower lows is the definition of a downtrend. That's how I want to place my stops. So if I short it under here and it gets back up through there, the market said, wrong time. take your small loss, come back maybe again in a week if it sets up again, but don't fight it. Don't be an idiot. So edit looks to me like a good short candidate. Crocs looks like a good long candidate. I think they're good setups that we can potentially make money from. So let's wrap it up here real quick. The way I see it, we have 4 steps to this process. Identify the trade candidate. A 50-day moving average is a very simple way to do that. Number 2, create your plan. Start to anticipate what's going to happen. Look at that 65 or 30-minute chart. Ask, where does it come from? Where does it have the potential to go? And based on those numbers, is the risk worth the reward? Do we have a good potential setup? So when we have a stock that's on a daily chart above a rising 50-day moving average, we're calling that a stage 2 uptrend. Then when we look to the shorter term time frame, we want that trend alignment. So we don't want to, if it's in that anticipation mode where we see Crocs right now, that's what we're doing. We're anticipating. And if it breaks that higher high, we're going to participate. We're going to buy the stock. We're going to set our risk. And if it enters stage 3 and starts to turn sideways and the momentum's out, exit. And if it's in a stage 4 decline on the short-term time frame, but the big trend is still higher, well, let's just avoid it. Why fight the bigger trend? Just the opposite for a short. We have edit in a stage 4 decline on the daily time frame. So we want to look at that and say there's a short candidate. If it's so now it's in stage 3 on the intermediate term, we're going to anticipate. If it breaks below that Friday low, we're going to participate and manage risk. Once it starts to peter out on the downside and turn sideways, we're going to exit. And if it starts to rally, we'll just avoid it. What's the point? Number 3, we're going to stalk that trade. We're going to stalk it. That's what we're doing. That's the anticipation. Right now, Crocs and Edit are in stalking mode. It's good to be a stalker sometimes, okay? Enter the trade, set your stop, and then what? People sometimes say, well, the winners take care of themselves. Wrong. They don't take care of themselves. Wrong. My wife loves when I do that to her. Wrong. Maybe I should do it again. Everyone laughed. I won't. Right. I wouldn't do that. That would just be wrong. Enter the trade, set our stop, and then manage risk. The winners don't take care of themselves. You have to manage them. Your money's there. You have to protect it. Raise your stops in the longs. Lower your stops as it starts going down. If it comes into a prior level of consolidation, maybe take some off in anticipation that it actually might become resistance or it might become support on that stock that's declining. And remember, only price pays. That's, at the end of the day, what matters most. Control your emotions, have a plan, be objective, use simple tools. Whether you have a computer assist you with them, there's the science of technical analysis. There's a whole other business called the art of trading, and it's way harder than looking at charts. That's it. I hope everyone had a great time. I did. And JC, come on up here. Let's someone bring me a beer. Let's toast this. And any questions too?